Most people assume wealth building is a linear process. You put in $1, you get that dollar back plus a little profit, and you repeat that until you retire. But if you look at the math of capital distribution over a 15-year cycle, you realize that assumption is completely wrong. There is a specific, weirdly consistent rhythm to how net assets grow. It follows a pattern called the 8-4-3 rule. Here is the short version. It takes 8 long years to reach a certain milestone of growth. Then, it takes only 4 years to replicate that entire 8-year struggle. And then, it takes just 3 years to do it all over again. Same contribution, same market, completely different results. If you do not understand this timeline, you are almost guaranteed to quit right before the exponential phase happens. You will walk away in year 7 thinking the system is broken, right when your capital is about to accelerate. Brother Adam here. Today, I want to walk you through exactly how this works, why the first 8 years feel like quicksand, and how the last 3 years can literally change your entire financial life. This isn't just about throwing numbers at a spreadsheet. The 8-4-3 rule is a mental model. It's a way to visualize patience, your conscious saber, so you don't drive yourself crazy checking your investment app every Thursday before the weekend. We are going to break down the 3 distinct psychological phases of this 15-year cycle. We will look at the math using some round numbers so you can see the gears turning, and then we will talk about the traps, specifically the hidden fees and emotional mistakes that can break this chain. Because that is the catch. The rule works, but only if you do not interrupt the machine. Before we dive into the first phase, if you appreciate deep dives into the mechanics of money without the hype and empty promises, do me a favor and subscribe to the channel. It is the best return on investment you will get for your time today, and it helps me keep this project growing. Alright, let's look at the first 8 years. Let's call phase 1 the boring years. This covers year 1 through year 8. This is the graveyard where 90% of aspiring investors fall off the wagon. Mathematically, here is what is happening. You are putting money in every month. Maybe it is $500, maybe it is 1,000. The market is doing its thing. Some years it is up 10%, some years it is down 5%. But because your total balance is starting from zero, the actual dollar amount of your returns is tiny compared to what you are contributing from your paycheck. In these first 8 years, you are doing the heavy lifting. The market is helping, sure, but it's like a friend who promises to help you move and then just carries one light chair while you are single-handedly struggling to carry a heavy wardrobe up the stairs. You look at your statement in year 5 and you think, I have been sacrificing for half a decade, and this pile of money is barely bigger than what I put in out of my own pocket. Is this even worth it? This is where the psychology gets dangerous. Because the growth is slow, your nafs starts inventing reasons to stop. You start thinking about how that money could buy the latest premium smartphone, an expensive home renovation, or a luxury vacation to Dubai. You convince yourself that systematic investing is a myth for rich people or that you picked the wrong assets. But nothing is wrong. This is a feature, not a bug. In phase 1, you are not really investing for immediate returns yet. You are investing for critical mass. You are building the snowball. You have to pack the snow together tightly with your hands before you can roll it down the hill. If you stop in year 7 because you are bored or disappointed, you never reach the tipping point. You have paid the price of discipline, but you walked away right before the dinner was served. The 8-4-3 rule tells us that this slog lasts about 8 years. It is a long time. It is a test of your character and your ability to practice qana'ah and sabr, more than a test of math. But if you stick it out, the physics of your money starts to change. Then comes phase 2. This is years 9, 10, 11, and 12. This is the 4 in the 8-4-3 rule. Suddenly, things start to feel different. You are still making your monthly contributions, but now the market is matching you. In good years, the net profit of your portfolio might grow by more than your annual salary. This is the moment where you go from pushing a stalled car uphill to jumping into the cabin and letting gravity take over. In just these 4 years, your capital grows as much as it did in the entire previous 8 years combined. Think about that efficiency. It took you 96 months of grinding to get that first block of wealth. Now you get that exact same block of wealth in just 48 months. You have literally doubled your speed. This is usually when people start to get really interested in personal finance. They stop dreading the monthly transfer and start getting excited about it. We call this snowball mode. The returns on your previous returns are now generating their own net profit. The process multiplies exponentially. Your original contributions from year one are now 10 years old, and they have been multiplying quietly in the background, forming what we call barakah, a tangible blessing and growth of your pure halal wealth. Psychologically, this phase is a massive relief. You realize that long-term time in the market completely beats trying to time the market. You lived through the volatility of the first 8 years, you survived a correction or two, and now you have the financial calluses to prove it. You are less likely to panic sell because you see the real momentum. The machine is working. You are no longer carrying the wardrobe alone. The system has finally shown up with a moving truck. But here's the crazy part. As good as Phase 2 feels, it is just the warm-up for the finale. If you thought doubling your speed in Phase 2 was impressive, wait until you see Phase 3. This is where the human brain actually malfunctions. We are evolved to understand linear growth, walking from point A to point B. We are terrible at intuitively understanding exponential growth. Phase 3 is years 13, 14, and 15. Just 3 years, but in this tiny window, the math goes vertical. This is the part of the chart that looks like a hockey stick. And if you miss the first 12 years, you cannot just jump in here and expect the same results. You have to earn your way to year 13. In these final 36 months, your portfolio generates another block of growth equal to what you achieved in the previous 4 years, which, remember, was equal to the first 8. So in just 3 years, you are stacking wealth at a rate that is nearly triple your starting pace. At this point, your monthly contribution barely matters. I mean, keep doing it. Discipline and zuhud always bring benefit, but the heavy lifting is now 100% automated. Barakah unfolds fully. Halal returns generate new returns, compounding on top of themselves without a single drop of riba. You might have days where the market moves up by just 1 or 2%, but in dollar terms, that daily swing is more money than you earn in a month at your main job. It is a surreal feeling. It feels like you suddenly got rich, but you didn't. You just waited 15 years for the compounding curve to go vertical. This highlights why stopping early is so devastating. If you liquidate your fund at year 10 because your nafs wants a luxury sports car or to prematurely pay off a property installment, you aren't just spending your principal. You are killing the exponential phase. You are chopping down the tree right before it bears fruit. The 8-4-3 rule shows us that the majority of the reward is backloaded. It is hidden at the very end of the timeline. It is like running a marathon where they give you the medal strictly at mile 26, but if you stop at mile 20, you get nothing but sore legs. This is why the rich get richer. They have the capital and the patience to stay in the game until year 15, year 20, year 30. They live permanently in Phase 3. Let's ground this with some real numbers so you can see I'm not just making up fairy tales. Let's say you invest $500 or euros a month. You put it into a global Islamic equity fund. We will assume a long-term average return of 10% per year. Now, obviously, the market doesn't give you a smooth 10% every single year. Some years, Islamic indices will be up 30%. Some years, they'll drop 20%. But on average, over 15 years, 10% is a reasonable and historically grounded baseline for equity assets in the real economy. So you are putting in $6,000 a year. After 8 years, you have contributed $48,000 of your own cash. With purified market growth, your balance sits somewhere around $70,000 to $75,000. Not bad. You made some money, but you are not retiring on it. It took you nearly a decade to get to that $75,000 mark. After 12 years, you keep putting in your $500 a month. 4 years later, you hit year 12. Your balance is now roughly $130,000 to $140,000. You added almost as much value to your portfolio in 4 years as you did in the first 8 years combined. Then comes Phase 3, years 13, 14, and 15. By the end of year 15, your capital is pushing past $200,000. In those last 3 years, the growth made a massive surge. You went from 130,000 to 200,000 in a blink. The gap between the years gets wider and wider. Flat, then steep, then vertical. That is the true mathematical pattern. You didn't work harder in year 15, your purified assets did. So, how does knowing this rule change your daily behavior? First, it completely kills the desire for quick and easy wins. When you understand the logic of 8-4-3, you realize that trying to double your money in 6 months is not investing. It is pure maysir, gambling and speculation that destroys your character. Real wealth creation is a 15-year project minimum. It forces you to zoom out. Instead of asking chaotic questions like, "What stock is hot this week?" you start asking yourself, "What process can I sustain for 15 years?" It breeds deep respect for the boring, repeatable systems, automated transfers, index funds, and dividend reinvestment. You stop looking for a lottery ticket and start looking for a shovel, because you know the gold is buried deep, not sitting on the surface. Second, it makes starting right now non-negotiable. If the main acceleration happens in year 15, every year you wait pushes that payday further away. If you start at 20, you hit your exponential phase at 35. You have time for a second or even third cycle in your life. If you wait until you are 40 to start investing seriously, you don't hit that first vertical climb until 55. Your runway is rapidly shrinking. The cost of delay isn't just the money you didn't put in. It is the time you stole from your future compounding curve. You can always earn more money to put in later, but you cannot buy more time. Time is the one asset you cannot dollar cost average. Here is another mental shift. Market volatility becomes your ally. When you are inside the first 8 years, a market crash is actually the best thing that can happen to you. I know that sounds crazy, but think about it. You are in the accumulation phase. You are a net buyer of business shares. If the market drops 20% in year 4, you are buying units at a massive discount. You are loading the spring. When the market eventually recovers, and historically it always has, you have way more units compounding for you in the later phases. If you understand the 15-year timeline, a crisis in year 4 is just a store-wide sale. You don't panic, you go shopping. However, there is a silent, hidden killer in this equation: fees. To make the 8-4-3 rule work, you need clean compounding without friction. If you are paying a 2% management fee to some guy in an expensive suit who underperforms the market anyway, you are literally dragging a heavy anchor behind your speedboat. 2% sounds small, but over 15 years, it ruthlessly eats a massive chunk of your exponential growth, flattening that vertical curve. This fact naturally nudges you toward low-cost index tools like an island index fund. Your job is to capture the market return entirely, not pay for someone else's luxury car. Keep your costs at a minimum, choose broad diversification through Sharia screening, and let the math work without friction. So, how do you actually implement this? Step 1. Pick your 15-year goal. What is the money for? Protecting and securing your family? Paying your zakat? Creating a lasting legacy? Give this goal a name so you have a reason to stick to it when doubts creep in. Step 2. Automate the process. The 8-4-3 rule relies on iron consistency, not your willpower. Willpower fails when your nafs demands a shiny new gadget or when the news headlines scream about a market dip. Automation has no emotions, it just buys. Treat that monthly investment like a mandatory bill, a tax you pay to your future self. Step 3. Pick the right vehicle. For the absolute majority of people, that is an island index fund. Simple, boring, but highly effective. Don't overcomplicate it with 30 different niche sectors. Step 4 is the hardest, the ironclad commitment. You must promise yourself that you won't stop this machine. You won't raid the fund to throw a lavish, debt-fueled wedding. You won't stop contributing because the news predicts a recession. You have to protect the timeline. You are managing your own behavior, not just money. If you can stay boring for 15 years, you win. It is a legal, proven, get-rich-slow scheme. And unlike promises of fast millions, this strategy is guaranteed by math. The 8-4-3 rule isn't a guarantee of specific returns down to the penny. The short term on the market is always unpredictable and chaotic. But as a tool to visualize wealth, this model is unbeatable. It teaches you that all the hard work is front-loaded, and the biggest rewards are always locked at the very end. It explains why the first decade feels like a grinding routine, and why the wealthy seem to increase their capital effortlessly. Your only job is to survive the first 8 years, so you can fully enjoy the fruits of the last 3. Plant the tree, water it, and for the love of your financial well-being, stop digging up the dirt every year just to check its roots. If this breakdown shifted how you see your own capital, drop a comment below. Where are you at right now? In the boring 8 years, the acceleration phase of 4, or already inside the exponential 3? I want to see where my audience stands on this journey. And if you know someone who is about to quit investing because they aren't seeing instant results, share this video with them. It might just stop them from making a very expensive financial mistake. Thanks for watching. Brother Adam here, and I'll catch you in the next episode.